Hello and welcome to Switzer Investing. I'm Peter Switzer. If you think I look a little summery, well, I am, as I'm zooming in from Port Douglas today, where it's a wonderful 28 degrees, real swimming weather. But I digress. On tonight's show, we have Fairmont Equities' Mike Gable looking at four stocks that have taken off from their lows recently. That's Altium, Appen, A2M and Newick. He also looks at the stock he likes right now, namely Woodside Petroleum. Then Marcus Bogdan, who is the portfolio manager of my listed Switzer Dividend Growth Fund, tells us how he picks good companies and what is the latest addition to the Switz Fund. Joining us next is Simon Pressley of Propertyology, who tells us why granny flats might be good for income but aren't great for capital gain. Something you should consider if you're thinking about buying a property with a granny flat. And finally, Ying Yi Ann Cheng does her regular catch up at what's the outlook for interest rates. So without any further ado, let's go to Mike Gable. Well, to kick off, we're talking to Mike Gable, founder of Fairmont Equities, about a number of stocks that I've written about and talked about on the program, and they seem to have taken off in recent weeks. I just want to see whether we can trust this takeoff, and Mike's the right guy to talk about. Mike, thanks for joining us.
Thanks, Peter.
Let's not muck around, because I'm in Port Douglas. I have to make sure we don't have a Zoom problem. Let's kick off with the first stock on the list, namely Newick. A lot of problems in the news. What are the charts saying?
Yeah, look, I mean, we have looked at all these stocks previously. Last time we spoke about Newick, so I mentioned how I noticed that it seemed to respect a 20-day moving average. So by that, I mean that the share price tends to either sit on top of this moving average when it's doing well, or when it's not doing well, it tends to follow it underneath. So at the time we spoke about if it gets above that moving average, that would be a sign that it's ready to kick on. Unfortunately, even though it's had the odd sort of good day there, it's still trading under that 20-day moving average. So for me, it's still a little bit too early. Obviously, it's been in the news. You know, hopefully we're getting to a point, if you are a shareholder, where all the bad news is out there and it's all priced in. But for me, it's still just a little bit too early.
Still for the courageous, Mark, eh?
Yeah. Let's
go to Altium. It's had a nice rise and sort of had a takeover offer as well.
Yeah, so look, Altium, obviously, big move up there. So the offer is trading at 38.50. What I've put on the chart for our viewers is I've thrown a little blue arrow up at 38.50 so they could see where that offer is. At the moment, this one I think is pretty clear. You've got an offer that's higher than where the shares are trading. They did trade close to it on the first day and they've drifted back. So that's clearly a sign that, you know, maybe the market doesn't quite believe that this might go through. You know, because it was a nice premium to the previously traded price. I know the company has said that they'd like to see something higher than that. But at the moment, it looks like the market's not buying it. So the question is, well, do you look at a share price trading around $34 and say, okay, well, if it goes through, I'm going to make at least $4 on it. I prefer to look at the risk first, and that's if it doesn't go through, and the share price heads back to where it was previously, which is closer to $27. So I guess if we continue to see this share price drift back closer to that $27, where the risk reward looks a little bit more attractive, then it could be an opportunity. Again, at the moment, it looks a little bit too early to be jumping in.
Okay, mate. Let's go to the next one now, and that is Appen.
Yep. Yeah, there's been a couple of really nice up days on Appen, but I suppose when you look at the share price performance over a year, it's merely just a blip in terms of the big downtrend that we've seen in it. In our last show, Peter, I mentioned that there was previously a lot of support around $16, and if it can get its head back above that, then I'd feel more confident in Appen. At the moment, it's still drifting under that. So on a positive note, it's not getting any worse, but I just think it'll base build for a while. Obviously, when we with our market, trends seem to change every couple of days in terms of are we back into growth stocks or not. I just think this one needs to use a bit more time. So we could be patient with Appen. And as I said, if I could see it get through $16, because I think there'll be a lot of selling anywhere near there, if it can get through that, that'd be a great sign. That'd be a good start.
In many ways, all of these stocks I've jumped in early because I'm sure lots of people are asking the same question as me. Is it time to get in? And I half suspected I'd be getting cautious type answers from you because you are a cautious kind of guy.
Yeah, and it always comes back to your time frames and all that as well. I mean, I like stuff that's already got the uptrend to it.
Yeah.
Maybe I'm impatient as a young guy, but I'd like to see that uptrend. But as a positive note, what we saw with Altium, there is still really good interest in that sector. So I guess it's just a matter of time.
Yeah, it was interesting. I know I noted that a US analyst, I think it was an RBC analyst, actually made the point that he thought Autodesk, the company that actually made the offer for Altium, he liked it on the basis that they would get this Altium deal across the line. So that intrigued me. But once again, it's all speculation. He could be totally wrong. The deal might not come off. But it's just an interesting one to keep an eye on. Mike, let's go to the final one before we get your favourite one for this week. And that is A2 Milk. Has a real battle with the market, starting to take off now, but once again, I suspect you're going to say it's too early.
Yeah, you're right. Look, it is, but again, I mean, when you have a look at a one-year chart, it looks like it hasn't done anything. But if you got in a few weeks ago, you've seen some nice moves. I still think this will be volatile for a while, so it might take another few more months. Hopefully we could see a bit more of a base build in that. And, all the sellers are out of the way and all the negative press is out of the way. So for me, it's, if I'm just talking about a chart, it's still a downtrending chart. It's not uptrending yet. So still just a little bit too early, Peter.
Okay, so all four really are for the brave, and probably the most scared of the brave would probably look at Altium before the other three.
Yeah, exactly.
Okay, mate. Let's go to your more safe and interesting. Well, I'm presuming this is going to be a buy, but you could always come with the sell.
No, look, I mean, we want to buy things, so I've got another buy, which is Woodside. But what I thought I'd do is just follow you up on something you asked me last week, Peter, and that's with these buys that I'm putting at the end of these little segments. You wanted me to make sure that I updated your viewers as to my latest views. So I went back and had a look at my stocks since the start of the year. Hopefully I haven't missed any. So we had Wesfarmers last week, last time I appeared on the show, I mean. Previous stocks, I've got Aristocrat, James Hardie, BHP, Macquarie, Western Areas and Iluka. Hopefully I haven't missed any. Do I still like them? Yes. So all of them, apart from Western Areas, I've got for my clients. Luckily, all of them are actually higher than when I mentioned them on your show, Peter. So they're all heading the right way. So just so you know, I'm still happy with those, and I'll add Woodside Petroleum to that list today. That's my recommendation for today. So we could see with the Woodside chart, the share price has come back over the last few months, and then it's just kicked higher just over the last couple of weeks. So there's renewed interest in energy stocks. We've seen a bit of a breakout in the price of oil, and I think that will continue on as global demand increases. So to me, Woodside, even at current levels, is still a buy, so we can add that to my little list of recommendations. I think that's going to continue heading high here, and as promised, Peter, I'll let your viewers know if I've exited any of these for my clients.
Okay. One thing I must pick you up on, Michael, you said luckily. You don't get it right through luck, mate. You get it through hard work and historical experience. You wouldn't be here for luck.
You don't get them all right, Peter. I've got some wrong, and it's lucky that I haven't actually mentioned those on your show. So Touch wood, it's working out at the moment.
Okay, mate. Well, one thing we like is honest analysts. Thanks for coming on the program.
Thanks, Peter.
See you in a few weeks' time.
Thank you.
Become an annual Switzer Report subscriber and get unprecedented access to my 7 investing principles, where I reveal the exact strategies I use to invest. You'll get access to an exclusive PDF, video recording, and even a free copy of my book, Join the Rich Club. With a 30-day money-back guarantee, a Switzer Report subscription is one of the wisest investments you can make towards your future. Find out more at switzerreport.com.au/YouTube offer, or click on the link in the description below. Joining me now is the portfolio manager of the Switzer Dividend Growth Fund, Bogdan. Marcus, thanks for joining us.
Thank you very much, Peter. Good to be here.
Now, I should say to the audience that I am always giving other fund managers and other brokers a lot of free publicity. So I thought, why not give my fund a bit of publicity as well by introducing the new manager of the fund and get an idea of what kind of stocks he likes at the moment, which ones are great dividend payers, and also get an understanding of how he picks stocks as well. So Marcus, let's kick off with the key question. What are the 3 what I think you think is the most reliable dividend payers in your portfolio?
I think if you look at Commonwealth Bank, Wesfarmers and Woolworths, and just the deep history of consistent performance of those companies to deliver both earnings and dividends for shareholders over a number of years would be the standouts. Now, they've all done particularly well in terms of share prices more recently, but I think that is a justification of how well they've actually executed through the pandemic. Each of them are market leaders, and I think each of them have also increased their competitive advantages in their respective industry sets. Commonwealth Bank is leading on technology. It is leading on mortgage growth, deposit growth, and has the strongest balance sheet, and has a prudent payout ratio of around 65% for their dividend. And that should equate to a fully franked dividend of around 4% if we go out to 2023. And we're starting to see a recovery there in the banking dividends, and I think CBA will lead that charge. And then we certainly like the areas of consumer staples, the consistency of the earnings that they've been able to deliver. Both Wesfarmers and Woolworths have increased their competitive position over the last 18 months. They've both initiated and driven an online platform for both Bunnings, Officeworks, and then in Woolworths supermarkets. That has gained a great deal of traction, and they're delivering earnings growth. And when we're looking at good dividend paying companies, looking at underlying earnings and the profile of earnings is particularly important. So I stand out of those 3 companies. They're all household names. They've all got deep listed history in the Australian market. They're number 1 players in what they do, and they've just been able to deliver consistently over a number of years.
Okay, well, the next question is, how do you assess a stock or company that you want to invest in? And let me just throw a little bit onto that question. Considering those great companies you've already mentioned, do you get to a stage where even you aren't prepared to buy them for the fund because maybe the market has overpriced it, and therefore you wait for the market maybe to sell off and buy in again at a lower price?
Yeah, I mean, valuation is always important, and we do want to have a margin of safety in any of the companies that we look at. And if we go back to those three companies, yes, they have performed very well recently, but I think there is justification in those premiums. But we've also been looking at what we would say quality laggards, companies that we believe that the underlying business fundamentals are very sound. They've actually delivered earnings and dividend growth, but have lagged the overall market. And some of those companies, you know, some things like Medibank, Suncorp, but the overarching thesis for the portfolio is looking at those quality franchises, what we would classify as quality at a reasonable price. And we focus on quality because they are the most dependable dividend paying companies. And so that assessment of the earnings quality, the history of earnings, the sorts of returns that they've been able to generate is particularly important. Another incredibly important attribute on the companies that we like to earn is balance sheet strength. And both earnings quality and balance sheet strength have a really testament, no matter what downturn that you go through, if you've got those two components, you'll generally do much better than the market in times of duress. And you will have the ability to continue to pay dividends as well. Management and management execution is particularly important. And so we overlay that lens of quality in terms of management history and execution. And then the final part is obviously the valuation. Quality companies do tend to trade at a premium to the market, and that's for justifiable reasons. It is the consistency of execution. But we do watch a range of quality companies in the market very, very carefully, and we're very attentive of picking up those companies that we believe that the underlying businesses are incredibly solid. They've been underperformers, and they're the ones that we're sort of really most attracted to, and they're the ones that more of our attention has been paid in recent months as the market has moved substantially higher.
Yeah, I must admit, even though this is not a dividend stock, I couldn't resist buying CSL when it was down at $260 because it's a classic, great company that was a laggard at the time.
Absolutely, and also, I mean, it's an interesting discussion because, you know, they've got a dividend yield of around 1%. The cash rate there is at 25 basis points, so you're still doing better than cash. But then you're also seeing a company that has historically, and I think going forward, will be able to grow their earnings by around 8 to 10% per annum, and that will translate into that uplift in dividend also.
Okay. Well, last question, mate. What is your latest acquisition for the fund, and what attracted you to that company?
So in more recent months, we have acquired Amcor again in the portfolio. That would definitely be classified as a quality global leader in packaging that has delivered very consistent growth, but has lagged the market. And so that was one of the reasons that we were attracted to it. It was one of the handful of companies that was able to grow their earnings through the COVID period, because in essence, they were supplying packaging to consumer staples, to the healthcare industries on a global basis. They've upgraded their earnings guidance to 14 to 15% from 10 to 14%. So the trajectory of earnings is a powerful thematic. And they've also consistently paid an attractive dividend. And so their dividend yield is around 4%. So for us, that was a good choice that we felt to put into the portfolio to deliver dependable earnings and an attractive dividend yield for the investors.
Okay, one last one, Marcus. As I was listening to you, I thought it was worthwhile bringing up. You know, you've recently been appointed to run my fund, and part of the reason was you've had a good track record of doing a dividend fund. And for people who are watching this, I want to make it clear that when you go into a dividend fund, it's not a term deposit. You can't guarantee your capital stays where it is, and your capital will go up and down, but generally it goes on a rising trend over time. But what kind of dividend yield have you been able to achieve, in the time? I think you've been around since about 2014, but correct me if I'm wrong. But what kind of consistent dividend plus franking have you been able to achieve?
Well, the prima facie dividend has been around 4%, and then there's franking on top of that. The great bulk of the companies that we invest in, if you look at Commonwealth Bank or Wesfarmers or Woolworths, are fully franked. And it may be worthwhile just touching on the attributes in terms of the dividend characteristics. We do have a good bunch of companies that pay higher dividend yields than 4%. The telecommunications, Spark, some of the REITs in the portfolio are yielding north of 5%, but with very lower underlying growth. But then we have a group of companies that are generally growing at a greater rate than the economy, that might be at sort of 3 or 4%, but are being able to translate that into consistently higher dividend growth as well. And so they're the sorts of attributes, but the blended dividend yield is around 4%, then plus franking credits on top of that as well.
Okay, Marcus, thanks for joining us on the program.
Thank you very much, Peter. Cheers.
I want to talk to you about the Switzer Golden Ticket promotion. Yes, our marketing department has been working overtime to come up with something great, and I think this is great. How would you like to win a free 1-year subscription to the Switzer report with all the great stock tips that the report produces on a weekly basis? Well, we are giving you, our loyal audience, the opportunity to do just that. From now until June 30, with every purchase of my book, Join the Rich Club, which is 50% off until the end of the month, you'll enter your chance to find a golden ticket. Yes, a golden ticket, and you will win a free 1-year subscription to the Switzer report. So if you're a current Switzer report subscriber and you find one of these golden tickets, then we'll just add another 12 months onto your existing subscription for free. How good is that? We've got 5 of these to give away, so get in and good luck. Joining me now is Simon Pressley from Propertyology, and Simon put out a pretty controversial article recently where he said, keep the granny and ditch the granny flat. Simon, thanks for joining us on the show.
Hi, Peter. Always good to chat property with you.
Yeah, I'm glad you didn't say ditch the granny, keep the flat.
No, very affectionate. We all love our grannies, don't we?
Without a doubt. But a lot of people have thought, that granny flats are a good idea, but you don't think it is a great idea. So talk us through your logic.
Well, we're not saying you can't make money by buying an investment property that has the granny flat on it. What we are saying is that people need to go into these transactions with their eyes wide open and not just focus on get lured into buying a property with 2 incomes, which is how these properties are pitched to some people. The historical studies that we have done looking at evidence-based performance, the rates of capital growth, not saying you won't get any capital growth, but the rates of capital growth for what was probably originally a traditional house and then subsequently had a granny flat built on it, those rates of growth won't be anywhere near as strong as a conventional house.
Are you saying also that, okay, if you're buying these places, you may well be overpaying because you think that the income you're going to get in the future is going to be substantial, and that may well be the case. You will get, but when you come to sell it, there's less potential buyers?
Some people do pay too much for it because they feel that there's something precious about this property that has the ability to generate 2 incomes. But the biggest concern is people forget the end game, and let's face it, investing is a discretionary action. We don't have to do it. Those who choose to do it is because we want to be proactive and have a better retirement lifestyle. If we bought a property today, you or I, Peter, and we paid, let's say, $500,000 for it, and yours is worth $1 million in 10 years' time, and mine's worth $700,000. Clearly, you're going to have a much more comfortable retirement lifestyle than myself. So we need to focus on the things that are going to influence that end game. And if we own a property that's got what I call a concrete monstrosity in one corner of the dwelling, then when it comes time to sell, the line out the front of the open home will not be anywhere near as long with the property that's got the granny flat compared to a conventional property. The reason for that is 70% of buyers in any market at any time are the owner-occupier, and they would much prefer that detached house to still have the bigger yard that they can put a swimming pool in, or they can extend out for a bigger family or whatever, rather than have this concrete monstrosity there.
So what you're really talking about is the law of averages, because there are specifics where it would work. Like, for example, if you bought a home on a Gold Coast beach that actually had a granny flat at the back, that could be a very, very valuable Airbnb granny flat. No grannies, just Airbnb people on a high tourist area where you could arguably charge a lot. Is that a fair argument?
Well, but again, there we're talking about the potential income from the asset. Still down the track, when you went to sell that property, whether it's on the beach or anywhere, Peter, that's not going to appeal to an owner-occupier. Yeah. And that's always going to be 70% of the potential buyers of real estate. Yeah. So whether it's a property, with a granny flat or any other type of residential real estate property, the best potential for capital growth is always an asset that appeals to the broadest possible market, and owner-occupiers are 70% of buyers.
You may well be biased by your age. Now, I'm just guessing what your age is, but if you've got, say, an 18 or 19-year-old son who you'd love to dump in a granny flat out the back so he no longer terrorises the household, that could be appealing, but I would argue there's still a small number of people who want that kind of satisfaction in what they're buying.
A small number, yes. I'm not saying there'll be no owner-occupiers that want to buy a property with a granny flat. It could be a mature couple that, rather than sending mum into an aged care facility, they want to put her there. Or it could be someone with a home office. I'm not saying there won't be any buyers, but it will always be a very, very small percentage of buyers. And our statement is supported by formal studies that we've done. So we've looked at properties that were, bought, say, 10 years ago, sold today with a granny flat on them, and then getting another stock standard, vanilla property without that granny flat on it, owned for the same period of time in the same market, done that multiple times, so we've got a big enough body of evidence. And the gap between the rates of capital growth is significant. Yeah,
it is interesting. While we're on that sort of subject, you threw in the point that some people might like to have a swimming pool in the backyard, but a granny flat's in the way. A lot of real estate agents tell me that swimming pools aren't all that valuable for properties, but I always notice that on their signboards they actually show the swimming pool. What's your analysis on the value of a swimming pool in making a house sell more readily or not?
Yeah, I don't know that it makes it sell any more readily. Because it's a very subjective thing. Some people love a home with a swimming pool, some people don't. Some people would rather, if they want to go for a swim, go somewhere else where the maintenance is their problem. So I don't think it really adds to a value. But what I'm talking about with the granny flat scenario is as soon as you put that concrete monstrosity there, you remove flexibility. You remove the number of different ways that property could be used, and whether that's putting in a swimming pool for a future buyer or something else. You take away that flexibility, so therefore the appeal for the biggest possible segment of buyers is diminished.
Yeah, and I guess the bottom line also is that you have to add that to your capital base when you ultimately look at your return on investment. And for some people, it might work as a social thing. And I know cases where the granny has actually left the main house and gone into the granny flat to allow her younger family to take over the house. But you're right, it can lead to a less impressive return on investment.
Yeah, and it's too late after you purchased it. We're not talking about an outfit that the day after we buy it, we can go back to the retailer and say, can I please have my money back here? So the purpose of our report is to create awareness for people who might be pursuing investing at some stage in the near future, and they come across the concept of, geez, one asset, two incomes. How clever am I?
Right.
You need to think through all this. There's enough evidence out there now to show that the capital growth potential has been diminished by that secondary income source.
Have you seen an upshot in investors turning up to open houses and auctions? And secondly, are these investors sometimes the sort of people who want two income returns on a property?
First question about investor activity, it certainly has increased, and it's been a long time coming. The last 4 or 5 years right throughout Australia, Peter, the volume of investor activity has been well short of what's required, and that's why, with the exception of Sydney and Melbourne at the moment, we've got a rental crisis right throughout Australia because we have had insufficient investor activity. So it has picked up in the last 3 to 4 months, and we expect that trend to continue. What was the second question?
Are we seeing at this point in time, Simon, a rebound in investors turning up to open houses and auctions?
Yes, fortunately we are, Peter. It's been a long time coming in this country. The volume of investor activity in the last 4 to 5 years has been well short of what Australia requires, and therefore, with the exception of Sydney and Melbourne at the moment, right across Australia we have an all-time record high rental crisis. People living in cars and tents because there's insufficient rental properties, and that's a byproduct of investor activity. So the last 3 to 4 months, we have seen an increase in investor activity, and we need this run to continue for sure.
Okay. Now, on that subject then, are you seeing evidence that some investors are going after the double income properties because it effectively, in some cases, even turns their property into a positively geared operation?
Yeah, there's always some investors that fall for that trap, and I do call it a trap because I think they're not thinking through the primary purpose of why they're choosing to invest and what their longer term goal is. Or maybe for some other investors, they've already got tight cash flow. So they might be asset rich, cash poor. They've got equity there to invest again. They want to do that, but maybe the existing investment properties are already sucking a lot of money out of the household budget. So they're trying to compensate for that by buying the next investment property that has a much better cash flow. Often the cause of the much better cash flow of a chosen investment property is usually what diminishes its capital growth potential. So people need to understand what creates growth and get that balanced decision.
Great stuff. Thanks for joining us, mate. And I'm glad you haven't got an anti-granny stance. It's just an anti-granny flat stance.
Love grannies.
All right, mate. Thanks for joining us.
Good on you, mate. Bye-bye.
Joining me now is the portfolio manager at Coolabah Capital and my Switzer higher yield fund, Ying Yi Ann Cheng, and she's a portfolio manager, and it's great to see you, Ying Yi.
Thanks, Peter.
All right, so we always have a chat about where interest rates are going. We've seen this week the Reserve Bank basically sticking to its story that they don't think interest rates will rise to 2024. Along on Wednesday came the economic growth number, and the March quarter came in at 1.8%, bigger than was initially expected. I think 1.1% was a kind of guess some time ago. It looks like we're annualised at 7.2%. Do you think this might eventually force the Reserve Bank to move early on interest rates?
Well, firstly, I mean, the key thing is the question of whether they will taper, because in terms of moving interest rates, they're currently doing quantitative easing at the moment, which includes the purchase of government bonds. So they're essentially purchasing the debt issued by the state governments and the Commonwealth government. So before they would be actually lifting interest rates, they would need to unwind other policy stimulus that they have going on at the moment. At the moment, we have the term funding facility, which is due to end at the end of this month, so June. Meanwhile, as I said, they're already doing quantitative easing. That's purchasing the debt of the Commonwealth government and also the state governments as well. So before they look to lift interest rates, they would probably wind back on that. And so when that term funding facility, and just by the way, for your audience, the term funding facility currently allows the banks to borrow off the RBA at 0.1%. And that is not being extended, which, the banks are awash with liquidity. Deposit growth is still very, very strong. And so by not extending that term funding facility, the RBA is actually de facto tapering, which means that it's not, creating that sort of same degree of easing, which it was doing beforehand. And if anything, our expectation is that the RBA will also continue to do QE as and when. And, we think that they continue with, rounds of QE as long as, the economy requires it, which is our base case. So in terms of interest rate hikes, I think that will be some time away. But in terms of tapering on quantitative easing, that could come in a couple of years' time, or, it could come in the next year, but it very much depends on, as you say, economic growth and other indicators. The key for the RBA, as we've spoken about in the past, it really all comes down to inflation and unemployment. So some of the things that we need in order to create inflation, for example, because inflation is not very high, other than the fact that we've had some rebasing effects, coming out of COVID. In order to generate core inflation, we really need also wage inflation. And that's been quite anemic. As you know, it's still circa around, under 1.5%. In order to get it back up, we need unemployment to fall, and we need unemployment to get back down towards, probably around below 4%. So somewhere around 3.5% to 4%. And so, that's its objective. And until then, I think we will continue to see stimulus via quantitative easing, i.e. government bond purchases from the RBA.
Okay, so the summary is, until probably the central bank is so worried about the strength of the economy that they start pulling QE, you're not going to even start worrying about rising interest rates. Is that a fair point?
No, that's right. And if anything, look, rising interest rates, I think we are about to see, and I think we've already seen it to a certain extent, this de facto tightening or lift in interest rates already from the banks not being able to access the term funding facility at 0.1% after June. So, up until now, up until the end of this month, the banks can borrow off the RBA at 0.1%, and then they can, provide mortgages, for example, to households or businesses in terms of business lending. When they stop borrowing off the RBA at 0.1%, they're going to be forced to, fund at wholesale levels. And trust me, that will not be at 0.1%. That will be, higher than that. So therefore, when they borrow at high rates in the wholesale funding market, they have to pass on that higher cost of borrowing when they lend out to households and businesses.
Okay. Now, Ying Yi, because you hang out with a bunch of fun and entertaining guys and girls, who love the exciting area called the bond market, and of course you work with the most exciting person in the country, Christopher Joy. One of your debates must be around, will the inflation that's coming through be temporary or transitory, or could it be here longer than the experts are predicting? Now, when you guys, I'm sure you've had a debate on this, around the lunchroom table or whatever. What are you guys saying about this? Do you believe that inflation is going to be temporary? And how long will temporary be? And be right too.
Okay, well, look, I think inflation is definitely a concern down the track. And, as we've seen from how concerned central banks, especially people like the ECB, so the European Central Bank, are obsessed with inflation. And that's because when inflation does come, it tends to be quite sticky and could potentially be an issue. But at the moment, we're not even at that 2 to 3%, target. So when we get there, then yes, we expect inflation to hang about, and inflation could be a massive issue down the track. But right now, we're not there yet. So I think inflation is going to be potentially an issue probably in the next, 3 to 10 years. But right now, we need to get to that point. And I think the central bank is much more willing, given that we've undershot inflation for so long, they're willing to tolerate overshoots in inflation.
But are you saying to us that sustained inflation is probably 3 or 10 years down the track, but we might see a spike in inflation temporarily because of the getting back to normal effect? And I used an example recently. I said, well, 6 months ago, if you could buy an airline ticket to New Zealand, it was cheap as chips. But now if you try and do it, because you can go to New Zealand apart from Victorians, it's expensive because everyone wants to get it. So airlines will push the prices up. This is the normalisation process. But after 6 more months, when everyone's flying again, hopefully, the prices will start to stabilise and price competition will come in and the inflation rate will fall. Is that a fair call?
Yeah, so look, so you're talking about rebasing effects. Yeah, definitely.
But hang on, no one knows what you're talking about when you say rebasing. Only you and your and your
rebasing just means
I got Andre laughing here.
As the economy normalises, yes, there will be temporary sort of shocks. I mean, we saw this in when we spoke last time. There was, in the US, there was quite, substantial numbers because they were looking at used cars, for example.
Yeah.
Want to, but again, having gone through that sort of a peak, people aren't going to be buying multiple used cars on an ongoing basis. So we won't see that. My reference to inflation being an issue in the 3 to 10 years is actually more around the concern that because we're pumping so much stimulus and money into the system, people are going out and borrowing and purchasing. So I think it's going to be potentially, a cyclical problem down the track where it could affect, growth negatively in 3 to 10 years' time, but not right now.
All right, so let's imagine the early phases of inflation, maybe in 2 or 3 years' time. How's that going to affect your fund? Positively or negatively?
Yeah, good question. Well, I mean, it will be neutral. So if anything, there's arguably a positive effect because the fund that we do run, the Switzer High Yield Fund, which is one fund amongst our other portfolios at Coolabah, but the Switzer High Yield Fund is 100% floating. So there's no fixed rate risk in the portfolio. So imagine if you were fixed rate, which we're not. Imagine having fixed your rate, say at 1%. Let's say interest rates move higher. You miss out on that move higher. You're not getting paid if interest rates are now at 1.5% or 2%, or stuck at 1% in terms of your income or the yield that you're generating as a bond investor, right? When you are a floating rate investor or you're invested in a floating rate fund, as interest rates move higher or that floating rate moves higher, you benefit from that because if rates suddenly move from 1 to 1.5, you will get that 1.5% yield because you're floating rate.
Yeah. Okay.
And which the Switzer High Yield Fund would be. And then our objective on top of that is to deliver, alpha or capital gains over the top of that.
Okay, Ying Yi, as always, great to catch up. But you must promise us when you and Chris start to worry, you'll get on the blower and we'll interview you straight away.
You will definitely hear from us.
Thanks very much.
And that's the show for this week. Thanks for joining us. And before I go, let me remind you our small cap conference is on next Tuesday. Go to our website to see how you can join in to see that program. And if you want more information about the kind of stocks that we've mentioned on the show tonight, go to switzerreport.com.au. Thanks for joining us again. See you next week.